Inflation expectations for the euro area economy continue to be firmly anchored, in line with our aim of maintaining inflation rates below but close to 2% over the medium term. At the same time, economic growth in the euro area remains weak, with heightened uncertainty weighing on confidence and sentiment, giving rise to increased downside risks to the economic outlook. In previous months, we have implemented both standard and non-standard monetary policy measures. This combination of measures has supported the transmission of our monetary policy. Today, we have decided to continue conducting our main refinancing operations at fixed-rate tender procedures with full allotment for as long as necessary and at least until the end of the 12th maintenance period of 2012 on 15th January 2013. This procedure will also remain in use for the Eurosystem special term refinancing operations with the maturity of one maintenance period, which will continue to be conducted for as long as needed. The fixed rate in these special term refinancing operations will be the same as the MRO rate prevailing at the time. Furthermore, the Governing Council has decided to conduct the 3-month longer-term refinancing operations to be allotted until the end of 2012 as fixed-rate tender procedures with full allotment. The rates in these 3-month operations will be fixed at the average rate of the MROs over the life of the respective LTRO. Keeping in mind that all our non-standard monetary policy measures are temporary in nature, we will monitor further developments closely and ensure medium-term price stability for the euro area by acting in a firm and timely manner. Let me now explain our assessment in greater detail, starting with economic analysis. On a quarterly basis, euro area real GDP growth was flat in the first quarter of 2012. Available indicators for the second quarter of the year point to a weakening of growth and highlight prevailing uncertainty. Looking beyond the short term, we continue to expect the euro area economy to recover gradually. However, ongoing tensions in some euro area sovereign debt markets and their impact on credit conditions, the process of balance sheet adjustment in the financial and non-financial sectors, and high unemployment are expected to continue to dampen the underlying growth momentum. The June 2012 Eurosystem staff macroeconomic projections for the euro area foresee annual real GDP growth in a range between minus 0.5% and 0.3% for 2012, and between 0 and 2% for 2013. Compared with the March 2012 ECB staff macroeconomic projections, the range for 2012 remains unchanged, while there is a slight narrowing of the range for 2013. In the Governing Council's assessment, the economic outlook for the euro area is subject to increased downside risks, relating in particular to a further increase in the tensions in several euro area financial markets and their potential spillover to the euro area real economy. Downside risks also relate to possibly renewed increases in commodity prices over the medium term. Euro area annual HICP inflation was 2.4% in May 2012, according to Eurostat's flash estimate, after 2.6% in the previous month. Inflation is likely to stay above 2% for the remainder of this year, mainly owing to developments in energy prices and indirect taxes. However, on the basis of current future prices for commodities, annual inflation rates should fall below 2% again in early 2013. Looking ahead, in an environment of modest growth in the euro area and well-anchored long-term inflation expectations, underlying price pressures should remain subdued. The June 2012 Eurosystem staff macroeconomic projections for the euro area foresee annual HICP inflation in a range between 2.3% to 2.5% for 2012 and between 1% and 2.2% for 2013. In comparison with the March 2012 ECB staff macroeconomic projections, there is a narrowing of the projection ranges for 2012 and 2013. The Governing Council continues to view the risks to medium-term outlook for price developments as broadly balanced. Upside risks pertain to further increases in indirect taxes owing to the need for fiscal consolidation and higher than expected commodity prices over the medium term. The main downside risks relate to the impact of weaker than expected growth in the euro area. The monetary analysis indicates that the underlying pace of monetary expansion remained subdued in the first 4 months of 2012. The annual growth rate of M3 fell to 2.5% in April, down from 3.1% in March, following strong inflows into money in the first quarter of the year. The moderation in annual M3 growth in April was mainly driven by outflows from overnight deposits belonging to non-monetary financial intermediaries, which includes entities like central counterparties, investment funds, and securitization vehicles. The annual growth rate of loans to the private sectors declined to 0.8% in April from 1.2% in March, owing to negative loan flows to non-monetary financial intermediaries. At the same time, monthly flows of loans to non-financial corporations and households were moderately positive in April, and the annual rates of growth stood at 0.7% and 1.5% respectively in April, broadly unchanged from March. Money and credit data up to April provide evidence that, as intended by our policy measures, an abrupt and disorderly adjustment in the balance sheets of credit institutions has not materialized. Given the current cyclical situation and the ongoing adjustment in the balance sheets of households and enterprises, subdued credit demand is likely to prevail in the period ahead. Looking ahead, it's essential for banks to continue to strengthen their resilience further. The soundness of banks' balance sheets will be a key factor in facilitating both an appropriate provision of credit to the economy and the normalization of all funding channels. To sum up, the economic analysis indicates that price developments should remain in line with price stability over the medium term. A cross-check with the signals from the monetary analysis confirms this picture. Let me now make a few remarks relating to fiscal and economic policies. Significant progress has been achieved with fiscal consolidation over recent years. It is of crucial importance to continue with the efforts to restore sound fiscal positions and to regain competitiveness. These are preconditions for stable economic growth. As a natural complement, the implementation of the new macroeconomic surveillance framework under the EU semester is necessary. In several euro area countries, excessive imbalances exist, and they need to be corrected. To this extent, comprehensive product, labor, and financial sector reforms will help foster sustainable growth. Competition should be strengthened in the product markets, not least by the completion of the single market. And wages should adjust in a flexible manner, reflecting labor market conditions and productivity. These growth-enhancing reforms would accelerate the necessary adjustment process and enhance job creation. Finally, the Governing Council very much welcomes leaders at the last European Council meeting agreeing to step up their reflections on the long-term vision for economic and monetary union. The Governing Council considers this a highly important step. Thank you. Before we start with the questions, let me tell you something that has nothing to do with monetary policy, at least in a very remote way. Today, amongst you, there are also students and their teachers who are attending this press conference. These students are the finalists of the Euro area-wide competition, the so-called Generation Euro Students Award. This morning they presented their monetary policy decision and their underlying reasoning of today's Governing Council decision. I don't yet know what decision these groups have taken. After today's press conference, I will announce the winner of competition among European and international schools conducted by the ECB. And on June 20th, we will have the European Award event with the participation of all Euro area winners. Thanks. Now I'm in your hands.
Okay, thank you. Let's start for the questions now. One or two recommended by media, and please present yourself and the media you work with. First, middle block, first row. Yeah.
Sylvia Wadwa, CNBC. Two questions. First of all, flippantly, if you see the downside risks for the Eurozone economy, and given the kind of tensions that we have at the moment, which are almost in panic mode, can you tell us about your deliberations why you decided against cutting rates today? And the other question, more of a general kind, can you give us a bit of a feeling from the ECB's point of view how functional or dysfunctional both the interbank market and the bond market are right now?
Yeah. Well, I think the thing to say at the very beginning is to appreciate the background in which this decision of today has been taken. We still have very low nominal rates and negative real rates. We also have, as you said, dysfunctional markets. The interbank market is really very dysfunctional. It's not working. And we have a certain amount of fragmentation in all the other financial markets, in most of the other financial markets in the euro area. I'm saying this because price signals in this situation have a relatively limited immediate effect. It's mostly quantity signals that are quantity policy measures that would address this background. Also, let me give you a few reasons why, in the end, we decided to take this stance. The baseline scenario of our staff projections didn't change. At the same time, we have to acknowledge that this baseline scenario is based on assumptions like, for example, an abating of financial tensions, like assumptions like reduced financial tensions in the future, and all in all, a world demand, external demand, that remains buoyant, I would say. So after the cutoff date of these projections, which was 24th of May, we had several soft data which point in another direction, to another direction. These data are soft data, PMI, orders, and other soft data of this kind. At the same time, we have also the confidence indices, orders. They all point in one direction, and this one is not upward. At the same time, I have to say that during the first quarter, we had hard data which pointed the other way around. We had construction production, which rose by 12% in March. New orders rose by 0.5%. Total export and import values went up by 3% in the first quarter. And German GDP growth rebounded by 0.5% in the first quarter. So you see that you have conflicting signals. We are fully aware that the most recent soft data are in a downside. That's why you will find several references in the statement to downside risks, and we'll watch closely, we'll monitor closely all the developments, and we'll stand ready to act. Thank you.
Okay, second row, please. Yes.
Jeff Black from Bloomberg News. Mr. Draghi, thank you. Do I understand you correctly by the response to the first question that you see the efficacy of a rate cut at this time as being rather limited? And then just on rates, could you also tell us if your decision today was unanimous? Secondly, on the matter of LTROs, there are again calls for the ECB to carry out another 3-year LTRO. Could you tell us if you think that that would address the difficulties we're seeing in the markets at this time? Thank you.
Well, the first question is whether this decision has been taken by consensus, and the discussion was, as I had the chance to say before, the discussion was quite complete. I gave you basically in the first answer the elements of the discussion. It was taken by, I would say, very broad consensus. It's a complex, the situation that's coming to be in Europe now, it's actually quite complex. And when you ask about the effectiveness of price signals, one has to keep in mind the present situation. So we think it's effective, but we have to be aware that the context is one where you have liquidity constraints and tensions in financial markets. So one has to appreciate the effectiveness of these conventional measures in this new background, in this new context. You asked about the LTRO. I think we've done 2 LTROs. These have been these have prevented other problems. These have prevented other problems, more serious credit crunches, possibly more serious disruptions of the financial and the banking sector. To a great extent, I would say, not all of them, but many of the stress indicators are now slightly better in spite of the worsening of the recent time, slightly better than what they were in November. And so the issue now is whether these LTROs would actually be effective. And we think that so far, there is, again, we have to refer to fragmentation. There is plenty of liquidity in some parts of the area, and there are shortages in other parts of the area. Then we should ask why. Is this because of a lack of liquidity? Is this because of monetary policy? Some of these problems in the euro area have nothing to do with monetary policy. That's what we have to be aware. And I don't think it would be right for monetary policy to feel other institutions' lack of action. Thank you.
Okay, your neighbor, please. Joanna.
Johanna Träg, Market News. We hear that you, Mr. Van Rompuy, Mr. Barroso, and Mr. Juncker are on a committee to save the Eurozone and will present a master plan or roadmap going forward in June. Can you tell us what your precise role on that committee is? And are you not concerned that getting involved in such an extremely political process early on, you might undermine the ECB's independence? My second question is on Greek banks. You hinted in the European Parliament on Thursday that after the capital injections, Greek banks have access to your operations again. Can you confirm that all of the big banks have full access to regular ECB refis now? And if not, where are the remaining problems? Thank you very much.
Well, on the first question, we've been tasked by the European Council together with other institutions to perform this. I don't think this would present any threat for the ECB independence. One has to see what outcome is coming out of this, and it's better to be part of the outcome rather than being outside the process. So, having said that, the work is in progress. It's potentially, as you can all understand, very important work, and we'll certainly contribute with all our skills and expertise to this work. We also are all convinced that this work is in a sense, the beginning of a process which would give substance to a European vision for the medium and the long term. The point about Greek banks, I said that we welcome the fact that the 4 Greek banks that were lacking capital had been recapitalized, and therefore they have been readmitted as a counterparty to monetary policy decisions. And so that's important. Thank you.
Okay, the same rank. It's Alessandro, please.
Alessandro Merlio, Il Sole 24 Ore from Italy. I was wondering if there's any way you can envisage that the Spanish banks, as requested by the Spanish government, will receive some form of help without going through the Spanish government. The other question, again, on Spain, there's a lot of talk, or Spain and more generally about the situation in the markets. There's a lot of talk, including the Commission, which you're part of long-term solutions, but there seemed to be very little emphasis, at least from the politicians, on the emergency that you yourself have described in the situation in the markets.
Well, let me say at the outset that it's not, I don't view as the ECB's task to push governments into doing something. It's really their own decision whether they want to access the FSF or not. 2 things have to be said. One is that there is very soon, the first assessment of the SAP by the IMF will be available. My understanding is that it will be taken to the board of the IMF on Friday. That is the first assessment, but then of course we will have to wait for the independent assessment of the firms that have been hired by the Spanish government, which will be a granular assessment. I think that any decision about the FSF should be based on realistic assessments of the needs to recapitalize the banks and the money that it's available to the government without need to have an external support. The assessment has to be realistic and based on figures and data. Thank you.
Okay, the 5th row in the same block. Yeah. No. Well, okay.
Mr. Draghi, Arthur Beasley from the Irish Times. I wonder, could you tell us what your response in Ireland last week, and whether, in your assessment, the result strengthens the case of the Irish government for debt relief in respect of the onerous bank rescue that is underway in Ireland? Thank you.
Thank you. Let me say that some time ago, I think 2 months ago, someone of you, I don't know whether it was you, but you asked me about what was my expectation for the Irish referendum, and I said I was absolutely confident of a positive outcome. So I now cannot do anything but welcome warmly this outcome. It shows that the Irish people consider fiscal consolidation and fiscal stability a basic pillar for growth and for further European integration. So it's it's really a testimony of their responsibility. And for this, they should be complimented. Now, I don't think there was any ground or any statement of a quid pro quo for this. I think that decisions ought to be taken for what they are, and that's what we see. Thank you.
Okay, thank you. You're just in front of you in the same row. Yeah, your neighbor.
Thank you. Sakari Suoninen from Reuters. Mr. Draghi, you said that there has to be a clear spelling out of the Eurovision. So what is the ECB's Eurovision? And related to that, what do you think is the minimum requirement for the outcome of the EU summit later this month? And my second question would be, if there is some progress by governments towards a fiscal union, is the ECB willing to do something to help buy time? And if so, what kind of measures could those be?
I think I can easily answer the second question more than I can with the first. The second question is there has never been a quid pro quo between monetary policy decisions and not even fiscal really, but this is high-level decisions that concern the future of the European integration and the future of the euro area. So there is no sort of horse trading here. It would not be proper for us. It would not be proper for the counterparties. These processes have their own independent legislative route, and they can't be subject to the monetary policymaker decision. The other question was what is the vision? Well, in a sense, I kind of sketched this vision in previous statements in European Parliament. Let me say that let me start from the fiscal compact. That's a major important step. Countries like Spain, like Italy, like Portugal, like Ireland, like others, like Greece, even Greece, have undertaken an enormous effort and have achieved, as my introductory statement says, have achieved considerable progress. Now they have to continue and complete this. There have to be other parts to this. There has to be growth. But growth how? Through structural reforms, product, labor, financial sector reforms. And there has to be some understanding that fiscal consolidations in the medium term cannot and ought not be based only on tax increases. They have to be based on reduction in current expenditures rather than capital expenditure. So, in a sense, this has to be refocused towards reduction in current expenditures, towards expenditure in infrastructure and human capital, both at national and European level. But then you hear, when you really talk to people and to governments and to, in general, the population and citizens of Europe, that this is not enough, that somehow they don't see the benefits of this. Now, first of all, one would say, well, I mean, it's perhaps in some cases too early to see the benefits. But also, one can also add something else. The benefits, the full benefits, I think, could be realized, could be achieved if we were to clarify what the euro is going to be in 5-10 years' time. And this is where I think the efforts of the leaders are oriented, are geared to. In the next European Council, what we all expect is a sort of a clarification of this vision. When we say vision, we basically perhaps use it too much of a word, but we basically have in mind a path towards an objective with all the conditions that have to be satisfied in order to achieve this objective. And if you remember, you may not remember, you probably weren't born yet, but I think in the road to the euro was very much of that kind. In 1988, after several failures, that's right, you weren't born yet, but unfortunately I remember that, and Vitor too. in 1988, after several failures in the process to link the exchange rates, to try to coordinate monetary movements, you had one beginning towards having a common currency. There was a report, the Delors report, that was later changed and endorsed finally by the European Council. The important thing, as far as we are concerned today, is that that report, in a sense, spelled down a methodology. There was a road, there were dates, deadlines, and conditions to be satisfied. I think that's part of the effort that we have to project, that our leaders and ourselves have to project today. Thank you.
Okay, let's go to the block on the left, the row number 4. Yeah.
Thank you very much. Anne Cahill from the Irish Examiner. The European Commission, in their country-specific recommendations report last week on Ireland, said that the risks with regard to long-term sustainability of public finances appear to be high. Wondered if you agree with this, and given that bailing out the banks in Ireland has cost something like 40% of GDP so far, how important is it for Ireland to cut the cost of this funding, and when do you see it happening? Thank you.
Well, I don't want to comment on Commission statements, but basically I think what is meant by that statement is that Ireland has achieved remarkable, very significant, substantial progress on the front of fiscal consolidation, but also on the front of bank restructuring. And the implicit message is continue on this path. And in a sense, we already, in that case, we already see the signs. You've seen spreads going down for Ireland much more than probably any other country. So that one would not be excessively optimistic if one says that if Ireland continues in these efforts, the return to the market access is not a far distant perspective. It could actually be closer than we all expected until, I would say, 9 months ago. Thank you.
Your neighbor, please.
Stefan Balling, Börsenzeitung. Mr. Draghi, you've just said that some of the problems in the Eurozone have nothing to do with monetary policy. I would say the only problem that has to do with monetary policy is that inflation rate has been significantly higher than 2% for the last 1.5 years. What other problems would you say have to do with monetary policy? Thank you.
I think our primary mandate is maintaining price stability in the medium term. The inflation rate has been higher than 2% now for some time. It was due essentially, I would say, to oil prices, commodity prices, and the use of indirect taxation like value-added taxes. All these factors are, in a sense, raise the rate of inflation, but we should consider that they are one-off factors. And in other words, they are adjustment in the price levels. And only if you have second-round effects or pass-through effects, you can see the effects of this in the rate of inflation. But we've seen that inflation expectations have remained firmly anchored, and now are even more anchored than they were before. So, since we run our monetary policy with a medium-term perspective, the question we've always asked ourselves is when is the inflation rate going to go down below and close to 2%? And we had repeated oil price increases in the previous months, so this profile shifted progressively to 2013. You remember that originally we said that by the end of this year it would go below 2%. Now then we said it's going to go below 2% in the next year. Now we have the first hints that actually this shifting might stop. And in fact, we wouldn't exclude coming back.
Thank you.
Sorry? No, I said,
the question was, what other problems would you say have to do with monetary policy except
inflation? I think I've implicitly responded to that. Our primary mandate is price stability, and we think that if we achieve this objective in the medium term, with all our necessary instruments, we really contribute in the best possible way to growth. Thank you.
Okay, the row behind, Jack.
Jack Ewing from the International Herald Tribune. Mr. Draghi, you've spoken of a medium and long-term vision for Europe. Last weekend, you probably read that George Soros said that he thought the Eurozone had 3 months basically to get its act together. It seems like a lot of market participants agree. Are they overreacting? Is the situation not as serious as that, or are there things that need to be done in the short term? Thank you.
Thank you. No, I think they. I don't know whether 3 months is the right deadline, or whether even it's right to say that there is a deadline. I don't see the processes as complex as having created a monetary union. I would say I don't see this process conceptually being subject to a deadline. It's not. I don't think it's the right way to cope with these issues. But certainly there is sense of concern. I spoke before about fragmentation of our financial markets, and so to the extent that these market participants express their fears, they are certainly not incorrect. What they do, however, and many observers make the same mistake, I think, they underestimate the strength of the political commitment by the euro area member states. They underestimate the awareness that all of us have of the extraordinary benefits that the euro has brought, both in financial, money-wise, and in political terms, in terms of perspectives, and in terms of achievements, because after all, we had the 10 years that we had the euro have been 10 years with great price stability, with very low interest rates. So I think that's the mistakes they make, but certainly they're not wrong about being concerned, as we are. Is it a long-term vision enough? Well, it's certainly the starting point. But then the next step is, how do we substantiate this long-term vision with, I would say, medium, short-term action to this extent? I think one response is that even though not in the long term, but some things concerning this financial markets union could actually be achieved in a relatively rapid way. Other things of this concept of financial markets union, like everything that really entails mutualization, is probably more medium term than long term. But the key point is to clarify this process. Let me go back again to my memory, my recollections with the euro. There was a European Council, as I said, I think it was in '91, that established the euro and accepted this road to the euro with conditions that had to be satisfied. And interest rates were fairly acceptable in all countries, regardless from the fact that they had fairly different rates of inflation. You had countries with 7% inflation rate in 1990, 1991, and countries with 2% inflation rates. They were all linked by the exchange rate agreement. Then, in July '92, we had the Danish referendum, which really put in question the whole objective of this path, the end point. And in a sense, it kind of upset the whole process, because people didn't know how to cope with this result, which was contrary to the to having the euro at that point in time. Immediately, interest rates jumped. By several percentage points over 2 months. Immediately, risk spreads widened, valuing the risk in different countries according to their inflation rates, the state of their deficits, the state of the level of their debt, and so on. That's why I believe that the very fact, the only fact of having an objective, a goal, an endpoint, and a clear path design by itself would contribute to stabilize the financial situation in Europe. I think that people are concerned also because if we look around and we don't go with our eyes over the short term, if we only see signs of nervousness. So the concern is right, it is true, but I think it can be coped with by specifying, by clarifying what this vision is.
Thank you. Your neighbors on the same row.
Jean-Philippe Lacour, Les Echos. You say the decision today was not unanimous. There were some members on the council asking to lower the main interest rate, or can you clarify this point?
Well, a few members would have preferred to have a rate cut today. I would say not many.
Please go ahead.
You said that price signals are not maybe efficient at this time, given the background you explained us.
No, I didn't say they're not efficient or they're not effective. I said that the effectiveness of price signals has to be valued in a context that is very different from what it was 2 years ago. In the context of where you have dysfunctional or basically not functioning interbank markets, where you have different sovereign spreads, very different sovereign spreads. So that's the answer. But I wouldn't say that this is a reason it's a reason for not for cutting or not cutting rates today. It's a reason for studying carefully what the effects of these price signals that belong to conventional or traditional monetary policy would have in an unconventional, in a non-traditional financial market setting in Europe.
Thank you. Your neighbor?
Ralph Atkins from the Financial Times. Two fairly quick questions. You just acknowledged that there was discussion about an interest rate cut this time. Could you clarify what the ECB's position is about the zero bound? If you were to cut interest rates, say next month, would you also lower the deposit facility rate to zero as well? And second question, then you can answer. You also opened the possibility.
I see that experience actually plays a role. Teaches.
Thank you. You also left open the possibility of another 3-year LTRO. I should also ask about the SMP program, because the demands have got louder for a reactivation of the SMP. Yields on Spanish government bonds, as you know, are back at levels we saw last July and August when the ECB did intervene. Is that also a possibility in coming weeks and months? Thank you.
I think experience actually teaches only up to a point, because it's very difficult to respond to the second question either. I would say that the standard response, that is to say the monetary policy instrument is there, it's temporary, and it's not infinite, applies to both SMP and LTROs. There's a certain economy of scale with this. But basically, I think that's what I can say really in all.
Okay, the first question.
I'm sorry?
First question.
The first question was, well, the first question is, as you said, actually, very correctly, I cannot answer the first question because, let's see, because, try to say, we never pre-commit.
Okay. Next question. Yes, your neighbor.
Financial Times Deutschland.
I'm sorry, I can.
Wolfgang Preußel, Financial Times Deutschland, is working now. You extended some of your liquidity provisions for banks, and there is the possibility of another 3 years LTRO. One of the problems of some banks, especially with the countries that are more subject to the crisis, is collateral. You have already extended the possibility of posting collateral significantly. Do you think there is further scope for further extension of the collateral and lowering the requirements? And secondly, roughly 2 months ago, you said that the worst of the crisis was over. Do you think this assessment was correct in hindsight, and would you still say it again? If not, how would you characterize where we are presently in the crisis? Thank you.
Yes, on the first question, we have to assess exactly what the funding conditions of the banks are. We don't think that all the opportunities offered by the second LTRO have been fully exploited. As I said many times, the two operations are so significant in their size and so complex in their effects that we don't think they have actually exhausted all their effects. So we will look at how the funding conditions proceed, and then we will make up our minds. Also, we have we have to assess whether all the opportunities offered by the broadening of the collateral eligibility have been utilized, and then we'll see. Our point basically is that the point that I want to make on and on, and I've made on and on, is that the ECB will keep the liquidity lines open to solvent banks, and we'll have to see the collateral. That's now. What was your second question?
The crisis, the worst of the crisis.
Oh yes. I remember one comment by someone who said at that time. He said, "Oh, this comment will haunt him for the months to come." Well, first of all, let me say one thing: that the actual statement was not exactly the worst is over, but it was the worst is over, but there are serious downside risks. But to be fair, the serious downside risks have been taken off the sentence, and so I was represented as having said only that. But the point of fact was that basically when I made that statement, it seemed that all the signals of tensions in the financial markets after the incredible situation in November and December were about to fade away in a rapid fashion, which they did, and now they worsen again. We are not yet at that level, however. So this is the first point I would like to make. The second point is that to some extent we believe that the weakening of the economy is due to the potential weakening of the economy, the possible weakening of the economy of the euro area might be due to a credit contraction that really started last year. And we may have to go back to July, August, when this credit contraction started, because banks had ahead in the first quarter of this year, they had this very serious funding situation. You remember there were 230 billion of euros of bank bonds coming due in the first quarter, and on top of this you had about 300 billion euros of sovereign financing needs for this first quarter. So banks actually started, you could see credit flows going down way before the end of the year. So in this sense, I think credit flows seem to have stabilized. We have to distinguish, because the complete figure for loans, as I read in the introductory statement, still has a negative growth rate. But when you go within this, when you look at within the loan concept, you see that loans to non-financial companies are actually timidly positive, and loans to households also are positive. And I think this is the first month that both components are positive. Last month you had negative for corporates and positive for households. So I mean, I'm trying to rationalize what I said, and I hope I've been, I guess, 50% convincing.
Okay. Let's go to block in the middle, third row, please, at the end. Yeah.
Brian Blackstone with the Wall Street Journal. There seems to be a concern, especially outside of Europe, that the debt crisis here is starting to have real economic effects in other parts of the world, not just the Eurozone, in hard data as opposed to just confidence, like employment output. Do you share those concerns? And what would you say to people, not in the financial markets, but citizens in other countries who might be angry or concerned that the debt crisis here is starting to affect their employment prospects, their retirement savings? What kind of message would you send to them? Thank you.
Yeah. Well, on the capacity of the European economy's crisis to affect the rest of the world, I have some. On one hand, I think it has to be right. There are some parts of this crisis that unavoidably affect. We are the second richest economy in the world, so if this economy weakens, then we certainly are going to have some impact on the rest of the world. But if we carry this reasoning too far, we end up saying that the United States is actually a closed, small economy, which I never thought it was. So it's I don't think we should carry this reasoning too far, frankly. It seems that all the problems that of a country with a high and rising deficit, with high public debt, and so on, all the problems depend on Europe. However, there is something, as I said, there is also something true in this when we say that the general financial market tensions do depend on the financial market tensions that we have in Europe, or at least depend perhaps is a strong word, but they are certainly related. In other words, the transmission that takes place through financial channels is perhaps stronger than the transmission we see across through the traditional multipliers effects. I think we have to say this. Well, what we can say, it's. You asked me what I could say to the citizens of Europe about this crisis. Outside Europe. Well, I said that I think I responded to that question. Basically, I said that Europe may have some responsibility, but these countries have their own responsibilities, have their own policy problems, which are still unaddressed, they're still unresolved. And so I think it's not, I would say, balanced to say that only Europe has a responsibility. I think all of us, and this perhaps is going to be the main message of the G2, the oncoming summit, of the G20 summit, which is going to take place shortly in a few days in Los Cabos in Mexico, that all countries, all areas have to work together, and they have, first and foremost, they have to address their own problems. And then they should worry about the spillovers of their policies or lack of policies to the rest of the world.
Thank you. Your neighbor and then the first row, and we will take the last questions afterwards.
Mr. Draghi, Todd Buell from Dow Jones Newswires. If the ECB brings the main interest rate below 1%, which it seems from what you said might be the case next month, that would mean that the main interest rate would be below the level that it was during right after the Lehman Brothers crisis. And is that sending a signal, perhaps, that the situation is as bad as it was then, if not worse? And a second question, if I may, how would giving the ESM a banking license be viewed in light of the prohibition of the ECB financing governments? Thank you very much.
Well, thank you. The first is, the answer is, it's a situation like it was at the time of Lehman? The answer is no. The answer is no. We are rightly alarmed that there has been a stress in the markets, and some of the indices that seem to have pointed to a stabilization of financial markets until, say, 3 weeks ago, now they are going upward again. But I would say that we are still far away from that situation. I think, again, thinking in the long-term perspective, if I have to define the main difference between then and now, is that that was a major banking failure coupled with a pre-existing financial crisis of world proportions, which we, frankly, I wouldn't say didn't know, but it took us a while to understand how it was propagating, which were the main causes. And so it took us time to understand the financial crisis. It took us time to understand how to manage a failure as big as Lehman's. Now it's different in a sense, because to a great extent we know exactly what the problems are. So I think that's the main difference between now and then. And so I don't think the situation is at all as bad as it was. On the ESM, the ESM treaty at the present time forbids the ESM to recapitalize banks directly. So we have to keep in mind this, that this is what the treaty says. Would it be better if the ESM were to recapitalize banks directly? The point is, from one viewpoint, the answer is yes, because the ESM could recapitalize banks without the debt of the country going up. But there are certain other dimensions of this that should be appreciated. The first is, and here we are talking about, in a sense, in a conjectural way, because, as I said at the beginning, the ESM does not allow this. The ESM treaty does not allow this. But the first dimension is the ESM would then take up shares of the banks that it would recapitalize. Then the issue is, do we really want to have an ESM who's a share, who become a shareholder of banks? And have we thought, or at least let me say, again, the answer yes or no is difficult, but have we designed the ESM with the purpose of it becoming a shareholder of banks in the euro area? So the answer to this is, if we want the ESM to become a shareholder, then we have to design to make changes to the ESM. The ESM was not born for that. I think that's one answer. The other answer is that usually people say no to the ESM doing this, because then conditionality would not be enforced. This is not necessarily true. You can have an ESM recapping banks with the proper conditionality enforced at the financial sector level, at banks level, even at government level if you want, because so it's nothing is against that. But again, we have to rethink the operational modes of the ESM if we want the ESM to do these things.
Okay, thank you. First row and the very last question afterwards.
Marica De Feo, Corriere della Sera. Mr. President, speaking of reforms, Italy has passed an important market labor reform. Are you satisfied with this reform? First question. Second question related to EFSF and ESM. You once launched the idea of acting on behalf of EFSF and ESM. Did somebody come... only did somebody come up with or met your request or answered to this? Because I think nothing happened.
On the first issue, for me it's very difficult to respond, because the labor market reform is now in Parliament. It's being discussed. So we have to see what comes out of the Parliament before I can express a view on that. On the second issue is, yes, the ECB has been was asked by the leaders to act as an agent. All the work and the preparation for this have been undertaken, and so we stand ready to act now. So we are there. Should we allow another?
Okay, just very last question.
Okay, another question.
Yes, because I promised to this. Yes, the last question.
Thank you. Marcela Vélez for El Mercurio, Mr. Draghi. In the emerging markets, governments and in the emerging markets, governments and investors, as the colleague from the Wall Street Journal said, are really worried about this contagious effects if the crisis escalates, and the economies are already suffering. In that sense, they are looking for the ECB in any signs of confidence. At this point, what kind of instruments can the ECB to use to avoid this kind of big scale contagion that the governments and investors fears in the emerging markets? In the same line, my second question is, besides and more than clarify the vision for the euro, that is a kind of medium-term and long-term measure, what kind of measures can be taken right now in the short term to avoid the escalation of the crisis?
Well, I think that the second answer really responds to the first as well. I don't think there is a silver bullet for this. The ECB will continue to act to have its monetary policy oriented to price stability in the medium term. We think that this is our best contribution to growth for both the euro area and our trading partners and the rest of the world. As I think we have the opportunity to exchange in this press conference, we've seen that this crisis is the product of many, many factors. And so some of them have their roots in their national government policies. Others have their roots in the fact that our integration process has now reached a point where it has to question itself and decide whether it wants to move further or not. So I think that's one other reason for the crisis. But I think one should also remember in the emerging countries that it's not only Europe, because again, it seems that Europe is at the source of the problems that Brazil or China might have. I think it's there may be a grain of truth in this, but I wouldn't say that that the reason why the global economy might weaken in the near future is because of Europe only.
Thank you. See you next month.
Oh, by the way, let me say that the Generation Euro Students Award, they deserve an applause from us.
Yes.
Yes.